Hello everyone, I am Rajendra Prakash Sahu, Assistant Professor of Department of Commerce, Odisha State Open University. I welcome you all to today's session. So today we are going to start our third unit of financial management, that is measurement of risk and return. So let's quickly start the class. So first of all, I give you a brief introduction to risk and return. Now let's talk about the foundational concept, that is risk and return. Risk refers to the uncertainty of outcomes in finance. This means the possibility that the actual return on an investment could differ from the expected return. So it could be higher or it could be lower. On the other hand, return is the reward for taking risk. It's the gain or profit an investor earns from an investment, usually expressed as a percentage of initial amount investment. Understanding the relationship between the risk and return is absolutely crucial when making investing decisions. The general principle in finance is very simple. The higher the risk, the higher the potential return. And conversely, lower risk investment usually lower returns. This relationship helps investor access how much they are willing to take in pursuit of a certain returns. It's almost important to note that not all the investors are same. Some are more risk tolerant and may pursue aggressive growth, while others prefer safety and stability. In both the cases, investors uh, tries to make a balance between risk and return that matches their goals, time horizon, and risk appetite. In summary, understanding this balance is the key to smart investment and long term financial success. Let's now dive deeper into the concept of risk, a key factor in financial and business decision making. At its core, risk is the possibility of an unfavorable outcome. It means things might not go as planned, and in the business, this usually refers to the chance of losing money or not achieving the expected goals. There are two main elements of risk. First, uncertainty. We can't always predict what will happen, and unfavorable outcome. Second one, there's a chance the results may not work in our favor. In the context of business finance, risk often involves the chance of a financial loss, such as lower than the expected profits, rising costs, or market deadlines. We also use the term business risk to describe how much the actual money may deviate from the expected result. For example, if a company forecasts a certain level of sales or returns, any difference, positive or negative, represents risk. So the key takeaway in this is risk is always tied to uncertainty. Wherever there is unpredictability, whether it's sales, investments, or market trends, risk is present. So understanding this helps the business to plan better, take calculated risks, and make more informed decisions. Let's now look at how financial risks are classified. Understanding the types of business risk faces helps in better risk management and strategic planning. Credit risk is the risk that a customer, client, or supplier will fail to meet their financial obligation. For example, a buyer might delay payment or delay entire default entirely. This can disrupt the cash flow and create major financial stress for business. Market risk arises when changes in economic factors such as interest rates, exchange rates, or stock prices, for instance, if these rates go up, borrowing becomes more expensive, which can reduce profitability. Operational risk. Operational risk is tied to internal processes, systems, or even human error. It also includes risk from external events like natural disasters or cyber attacks. This type of risk can impact the day to day function and efficiency. Then we have other risks, which include things like liquidity risk, where the company may not have enough cash to meet their short term obligations, or poor supervision, where the lack of oversight can lead to a compliance issues or financial mismanagement. In essence, financial risk is business stems from the variability in expected returns. whether due to market, people, or processes. Recognizing the categories help companies take proactive steps and to manage them effectively. Now let's focus on return, one of the most important concepts in investment and return. Returns refers to the income generated from an investment. It represents the reward you earn taking on the risk of investing your money in a particular asset. Typically, return is expected or expressed in percent of the initial investment. For example, if you invest 100 rupees and earn 50%, 15% return, you would receive rupees 15 as your profit, making the total value of your investment rupees 115. So the formula to calculate return is return equal to price change plus dividend upon initial price. This means you account for the both changes in asset price and dividend or interest received during the investment period. It's important to note that return can take in different forms. First, actual return. Actual return is what you earned or lost after a specific period. Expected return is what you anticipate earning based on historical data or projection. Required return is the minimum rate of return you need to justify an investment, often factoring in risk. Now let's explore the concept of probability, which plays a key role in decision making, especially in finance and investment. Probability is the likelihood of an event occurring. It helps us quantify uncertainty and make informed decision by assigning a numerical value to how likely something is happen. So, for example, if the odds are 3 is to 1, then this means there's a 75% of chance 75% of chance of the outcome happening. In other words, for every 4 possibilities, we expect the event to occur 3 times and not occur once. A crucial rule to remember is that the probability in any given scenario must sum to 1 or 100%. This ensures that all possibilities has been taken accounted for. In the world of investing, probability influences how investors assess potential future outcomes. For instance, when analyzing the stock market performance, investors might estimate the strategies and more calculated choices. Finally, estimating probabilities is essential for effective decision making. By using probabilities, investors can access to likelihood of various risks and returns leading to a better investment strategies and calculation and make calculated choices. So, to sum up, understanding probability is crucial for evaluating risk, forecasting outcomes, and making informed decisions in business and investment. Let's now look at how risk and return apply to a portfolio rather than a single investment. A portfolio is simply a collection of different investments like stocks, bonds, or mutual funds. The goal of building a portfolio is to earn good return while managing risk. Each individual asset in the portfolio has its own expected return and risk level. But when combined, the overall portfolio return becomes an average of all the individual return weighted by how you have invested in each asset. When it comes to risk, things get more interesting. The total risk of a portfolio is not just the average of each risk asset, but because what actually matters in those assets moving in relation to each other. This is where diversification comes in. If the assets in your portfolio don't react at all the same way to market changes, you can actually reduce the overall risk without sacrificing the return. That's the power of portfolio consideration or portfolio construction. We also use probability here to estimate how likely different outcomes are. For example, what's the chance that portfolio returns are less than 5% or more than 15%? These estimates help investor access future performance and make decisions accordingly. In summary, a good portfolio balances risk and return and uses probability to help predict outcomes. So the key strategy in diversification, don't put all your eggs in one basket to help reduce risk while still aiming for strong returns. So this is all about today's session, risk and return. So thank you for attending this session. See you in the next class. Thank you.